What's up, gold miners? If you're sitting at home right now and you're asking yourself, how can I retire from real estate in the next 12 months? Well, you came to the right episode because my friend Christian Osgood did just that. He was able to successfully retire himself and his wife in 11 months using the strategies that we're going to be going over in today's episode. Today, we go deep into the tactics and the conversations, the dialogues that he uses with potential sellers, with potential private money partners. And that's just the tip of the iceberg for this episode. Christian also goes deep in how he built a successful business partnership, real estate investing partnership with Cody Davis, who I've had on in a previous podcast episode, as well as the conversations that he has with sellers leading up to when he asks for seller financing. What does that look like? He has a map, literally a map that leads to that conversation, and he's going to give that in today's episode. So if you don't already have your pen and paper ready, take it out because this is a doozy. Without further ado, everyone, Christian Osgood. Christian, welcome to the Gold Mine.
Hey, thanks for having me.
Yeah, man. I'm excited to chat with you today. Is he your better half or your worse half? I don't know.
He's the other half of business.
Other
I'm
half,
sure we'll probably get into that. But yeah, partnership. Yeah. We started out very much the same roles and have diversified quite a bit the different roles.
That's awesome, man. Yeah, no, I had a good time interviewing him, and I know that we're going to have a lot of fun together too. So, one of the things that really stands out to me when I hear your story, and I've been following you online for some time now, is the way you talk about the way in which you retired your wife, and that really, that resonated with me. So the claim to fame is you're 29 years old and in 11 months, you were able to retire your wife. So how does someone do that?
Well, out of necessity. So I'm in the greater Seattle area. So 2020, she's a kindergarten teacher, and the government decided that kindergartners are going to learn best over Zoom. So that was not going to work, especially in my wife's demographic. She was in a demographic in South Seattle where they had a lot of underprivileged kids. You had 6 different kids in a house, all trying to learn on Zoom with one of them in kindergarten. So that was a mess. Then you have all the other political craziness that happens from 2020 to 2022. Mm-hmm. And so I had this goal to retire my wife in 10 years. She wanted to have a 10-year teaching career. So I had like 5 years left, and I'd picked up a couple duplexes. Well, that goal went from, hey, she didn't want to teach the next year. And on top of all that, as soon as they went back to school, she got a back injury from a kid shoving her. So we had L&I issues. We had a whole bunch of political reasons to be like, okay, this job is not going to work. We have to figure out something else. Right. I already started buying some rentals. I was at 4 units, and I went, okay, how does one go from 4 units to financially not needing a job? And so the answer to that I found in GrowthCon, where I went with Cody Davis, and he had this goal of retiring his mom. And he's like, well, I figured about 50 multifamily units is about what it would need if the average cash flow I'm getting to hit that goal. And I'm like, okay, well, what's easier, doing 50 between the two, like each of us doing 50, or both of us doing 100? And we decided to partner up and both go towards the goal of getting 100 units between the two of us. And that is exactly what we did. We gave ourselves 2 years to do it, but we did it in 11 months.
A partnership like that is pretty rare because, I've seen more partnerships fail than succeed. So what was it about? I mean, so first of all, it sounds like there was a shared mission, maybe slightly nuanced, but like it was a shared mission, right? So that makes perfect sense. But a lot of people have a shared mission too. A lot of partnerships have shared missions that don't necessarily succeed. So what was it about that first interaction or those first few months that kind of like laid the foundation for that successful partnership?
I think there's a few rules for partnership that make them work. And the first one is that shared vision. You have to have a clear target of this is where we're going. And I think where a lot of people get lost, this is where I see a lot of partnerships fall apart, is we don't change anything or renegotiate until we hit that goal. And so I'll see people, because there's no such thing as an even partnership, and people who can't accept that fail at partnerships. There have been times like at the beginning of our partnership, Cody had 30 units. He was 21 years old. He had figured out the method of using creative finance to buy anything. He had been with, he had a mentor who helped get him started, but he brought more value in the beginning because he's done it more often. And so that was huge. As the partnership develops, I'm a business ops guy. So the hiring, the coordination, the remembering to pay bills, what are we doing with our businesses? How are we marketing ourselves? Those are all things that fall on me. So there was a point in the relationship, and it's probably the season that we're in right now growing, where I really shine. If you focused on who gets what equity and who's doing more and I'm happy with, it would not be a successful partnership at all. What we did is we kept it 50-50. We both pushed as hard as we both could. We both gave 100% effort towards the goal until we hit 100 units. And at that point, my wife left teaching. She wanted to help be part of the companies and started working in property management. That's where we started renegotiating things, because now you have two people from the Osgood clan working full-time in PM, and you have one guy who does more acquisitions, also owning half of our property management company. We reworked it where I'm like, okay, we hit our original goal. How could we change the pieces? And the simple change was I bought Cody out of the property management company by trading him one of our buildings. Cody's happy. I'm happy. Everyone manages stuff. But if you want a successful partnership, clear goal and target where you're going, you don't renegotiate anything until you hit that goal. And then once you hit that goal, you just do an evaluation. What are our current pieces? What would you like to do? What would I like to do? And what Cody and I ended up doing is I'll take the management side, and I'll manage the humans, all the people who work for us. Cody will do more acquisitions, and that's going to be our universe. And we're going to hit that. We're going to do that until we hit 300 units, which should be in another 6 or so months. And at 300 units, we'll reevaluate again. It is fun. It moves quickly because your transaction size goes up as you progress typically. So we closed on 22 units on Friday. We'll close on another 15 in, I think, end of October. And then we're still under contract for another 60. So it's like we'll pick up a lot of stuff. But then once we hit it, we'll look at the pieces again. I know Cody wants to move to Tennessee. I want to move to Texas. So we'll figure out our pieces once we're there. But yeah, that's the key to partnership. Set a goal, hit it, and don't change anything till you hit it. And that is it. It works every time.
That's awesome, man. Well, what I heard, and for the audience listening at home too, it doesn't sound like the two of you, when you came into the partnership, you had a shared mission. You had an agreed upon target. We're not going to renegotiate. We're not going to do it until we hit that target. But it sounds to me like at the beginning, you guys were still trying to figure out the dynamic. Like there weren't clearly defined roles from the beginning. So maybe I'm wrong, but what it sounds like is there weren't clearly defined roles at the beginning of the partnership. And so how long did it take you to figure out, okay, like, and was that just like trial and error? Was that just like, okay, well, you do this, you do that? Like, because I could see a lot of these partnerships where there's two people who have very, type A personalities, and I'm sure that's how the two of you are too, because you're very ambitious people. So how do two type A personalities who are very talented and very driven find a way to make that happen?
I think a lot of it just comes down to who you are as a person. But when you set that goal, you're just like, hey, we have the same goals. We both have some skills. I think the partnerships that fail are the ones who try to overscript it, because there's a certain amount of you just have to develop as a partnership. When you're starting and you don't have a lot of real estate, nothing matters outside of buying the real estate. Like building the business, there's nothing to delegate because we're acquiring properties. So initially, Cody comes in and goes, hey, there's 38 plex I want to buy, because I had this goal to get into 30 units by 30. That was one of my little sub goals there. And he's like, well, you're 29. So I can't help you there because you have 4 units and I want to buy 38 plex. And so that's going to put you at 42. I'm like, okay, perfect. On a deal like that, the whole focus now is how do we take it out? So now Cody and I both get on to capital raising. We both bring in money. the actual deal structure, I had the idea because it was not going to cash flow day one. I had the idea of, hey, with collections as low as they are, what if we did lower payments for the first 6 months and then they bump up in price to where the seller wants it? And the seller said that was perfectly acceptable. So like we worked on the negotiations, we worked on the capital raising. Once we got it done, it's the two of us on site doing management. I brought in the second deal. That was a deal in Seattle. That was from a family friend who saw us on YouTube, who thought that we were interesting and had a building to sell. So that one picked up 7. Then shortly after, a mutual contact reached out to us and had us buy 6 more units. And so that was in the first 3 months. But that's all we focused on. It's like, let's go acquire stuff. So everyone's all hand on deck. Let's acquire stuff. Then we realized we're not doing a great job of managing these things. Let's really focus in on managing. And I took the lead on that. And Cody did a lot of the bookkeeping there because he's a math wizard. But you evolve into the roles, I think, if you overscript it. The partnerships I see that look massively unbalanced is where you get one guy who's like, hey, I'm really good. Like, I have friends in a marketing company. I'm good at bringing on business. The other one's good. Like, I'm good at doing all of the grind of like putting together all the pieces. And what you end up with is a sales guy who brings on business and they're really good, but they don't do nearly as much work. And then you have someone who works 5 times as hard for the same amount of equity. And I've seen that happen in a sales company. I've seen it happen in marketing companies. I've seen it happen in real estate groups. When everyone overcommits to just doing one thing, you get huge imbalances. If everyone's just, hey, I'm all hands on deck and we're going to figure this out, but this is what we're building, I've seen those develop better.
Makes sense. So up until recently, my understanding is that the two of you have never used a bank to finance a property.
Yep. We have
together.
I've done one. My first ever deal was bank finance. There was a duplex. And that is the only time I've ever used a bank loan to pick up a piece of property. In our partnership, Cody and I have never acquired on a bank loan. That's correct.
Gotcha. So you've never acquired, period, on a bank loan?
Nope. It's all been seller financed. We have one that was acquired with hard money that we're refinancing. But no, everything is, we've never gone through a bank to buy a property.
And so if that's the case, what are the various financing techniques that the two of you have used to acquire?
Seller financing and a hard money loan one time.
Gotcha.
Just because the price of the deal merited it. It's a fantastic opportunity. We had a great price on the property.
Yeah. Were there equity partners on any of these deals as well? Like, were you bringing in, or were these all 100% seller finance deals?
Most of them did have an equity partner, and the way that we raised it changed for every single partnership. And that's one of the fun things about creative finances. Where the money comes from is just about aligning people's goals. This actually ties right into the partnership thing because you're partners with your capital partners. It's aligning, it's an order of deal, then debt, then equity. And a lot of people over focus on the capital because they don't have money. And so the first thing that goes like, oh, where do I find the money? Because I don't know how I'm going to buy it if I find a deal. And that's the opposite way of thinking about it. If you start with the deal, what is the opportunity? Then what is the debt product, which for us is almost always seller financing. So let's say the seller, for this example, is financing 90% of the property. We have to find 10% down. That's a pretty common thing for us. We do a lot of deals 10% down. Where does that 10% come from? Well, we just meet with owners of properties, and they're owners, not sellers. People who own real estate in our market, we meet with them all day, every day. That is what we do. And we just build relationships with people who are playing the same game. If you've been playing real estate for a while and you're doing it successfully, you typically have some money. We know what everyone's goal is because we have actual relationships with people. So when I find a deal, the partner I bring on is the person that individual deal hits their objective. Example, say they're like, hey, I'm trying to build a base of cash flow of $10,000 a month for my family. I'm partnered with one of my original home lenders, actually. He's trying to build that passive income. And I'm like, why don't we build an LLC where we're 50-50? And that LLC needs to bring in $20,000 a month. And that hits your goal. He's $1 million a year income earner. So he doesn't care too much about the day one cash flow. He cares about buying the portfolio that's going to yield that when it's built, stabilized, and optimized. For him, Any deal that has some upside that is, we're going to get at a great price, but will take some time to increase rents, that's the right investor for that deal. And that's how we raise capital. It's find a deal so we have a 12-plex and a 5-plex together right now. Both of them required some CapEx. So they're low cash flow day one, but they're massive cash flow deals in years, after year one. That's someone who can afford to wait because he's trying to build this over a 5-year period. Super easy. They bring in capital. We do the renovations. We refi and pull their money back out. Everyone owns the property without a single dollar invested in it. And they're that much closer to their cash flow goal. That's a perfect one. Another quick example. I had someone whose goal is to double their money every 5 years in real estate. It's another one who's a higher income earner. So cash flow up front is not as important to them. They're all about the equity growth. We just did a deal where they bring in the capital. The operating partners get all the cash flow, which means Cody and I have $0 in the deal, but we're getting paid every single month. At the end of year 5, we have an obligation to buy him out, or he gets our equity in the LLC for exactly double his money, which means he'll double his money every 5 years. And if we fail, he triples his money based on the value of the property. Total win for the investor, super simple structure. That was a deal where cash flow was okay day one, but it's going to be fantastic in the future. I didn't want to take on additional debt to buy that property because I would have been cash flow negative. Putting a partner on there like that was the perfect solution.
I see. So that's a very creative way of doing it. So you're bringing so there was some seller financing involved in that one too, I'm assuming.
Yes, there was. That was 90% seller financed.
Right. So there's seller financing, and so you're bringing in an equity partner. They're bringing in the down. You're structuring it to where you're realizing 100% of the cash flow as the GP, we'll call it, right? The person who's putting the deal together.
Yeah.
And then
managing partner. Yeah.
Managing partner.
Sure. Because we'll do everything we've done is JV. We don't syndicate. So they're not necessarily GPs and LPs, but effectively managing partners and general partners.
Perfect. So the managing partner then realizes 100% of the cash flow until year 5, at which point you're going to refi, full return of capital, split the cash flow 50-50, or they get the property. Am I misinterpreting that?
So at the end of it, it's a buyout. So the goal is if you have an equity partner, the goal is not to partner with everyone forever, because you hit the nail right on the head. Most partnerships fail over time. So we don't want to partner with everyone forever because the goals don't align forever with everyone. So we have a fixed buyout at a fixed period of time for all partners. So on that one, year 5, it is a obligation to buy them out. So I will buy them out for 2-to-1, then we'll own 100% of the LLC. Or
Gotcha.
if we fail to do so, then we surrender our equity in the LLC and they get the property. Now, the easy way to do that, like you said, is to refi, which we'd be able to do. However, we have a fantastic interest rate and a seller who's willing to extend another 5 years. I would like to keep that note in place. So what we'll likely do is we save the cash flow on the property. It will cash flow enough to buy him out. The real estate will buy the real estate, whether we refinance or not. So we'll likely just cut him a check. It was a $90,000 down payment. It'll be $180,000 in 5 years. Almost anyone with a reasonable job can save up $180,000 in 5 years. It's a reasonable buyout. You're buying yourself time.
Mm-hmm. Yeah, that makes a lot of sense. So what I'm hearing you say then is we're going to start with the deal. What are the benefits of the deal? And then at that point, let's find the investor whose goals are in alignment with the features and the benefits of this particular deal.
Yep. Know what people's goals are. Know what your goals are, because you're going to go into a partnership. And line up the deal, figure out the debt product, and then that will tell you who the right partner is going to be to close that deal. It's simple as that every single time. And we'd close the deal seller financed on average about every 75 days. And I make 5 calls a week. We're not grinding the phones. I have no software. This is Google Maps, figured out who owns the large roofs in my market, calling 5 people, booking a coffee meeting with at least one, assuming 3 of them don't answer. Generally, you call 5 people, you get 3 no answers, 2 people will pick up, and one of the 2 is going to be available for coffee. You book a coffee meeting, you meet with 50 owners, a year, assuming you take 2 weeks off. If you meet 50 owners in your market, you talk to them about real estate, communicate your goals in a minute or less and learn how they build their portfolio, you're going to learn everything about how to operate in your market. You're going to have every connection you need. If you need a reference for an accountant, a contractor, what have you, you're going to have every reference you could ever need, and you'll have more deal flow than you can handle. It's a very simple pipeline strategy.
Yeah, it's not rocket science, huh? But some people want to overcomplicate it.
Yeah,
like
I make one call a business day. I mean, it's like it cannot be easier than that. It takes no time. Maybe 30 minutes a day if you get in a good conversation with someone. But the goal of the call is to book the meeting. So it shouldn't even be a long phone call. You generate some interest. You learn something unique, awesome about them. Tell them when you're in town and go, hey, can I get you coffee? It's so easy. It takes an hour, maybe a week, right? Because you get 3 no answers. That takes no time. You left 3 voicemails. You talk to one person, they're not available or not interested in meeting yet.
Right.
They'll meet them later. And then you get someone who you meet with. And it's okay, you talk for 15 minutes, you book a coffee meeting. Then you get coffee, and coffee usually goes an hour and a half. If you have a great conversation, it usually goes over the hour you schedule. You're talking 2 hours of work a week to find the deals. It's nothing. People who get stuck on that, this works in every market, and it's not that hard to do. If you focus on, you're meeting with an owner, not a seller. You're not going to ask them to sell their real estate. You're not going to ask them for a deal. You're going to tell them what you're trying to build and learn how they build their portfolio. Whole model. That's all Cody and I do, both of us.
So you go out, you interview these sellers, interview them, right? Because what you're really doing is you're trying to extract information, but at the same time, plant the seed ever so slightly that, hey, we're always open to look. We're always looking for deals, kind of thing.
I wouldn't even go that far. So here's a good example, because this is what it looked like when I got started. Hey, I'm trying to retire my wife. Government just shut everything down. So my 10-year plan came a 1 year, and I have 2 duplexes. So I'm trying to figure out how to scale. They usually go okay, so why are you calling me? I'm well, you have the 12-plex down the street. We're property neighbors. I just wanted to learn how you got into 12 plexes. The natural response, since everyone asked them to sell, is, well, I'm not selling. Oh, perfect. I don't have any money. I just spent it on the duplex. However, I realize I do need to go bigger. Do you have any piece of advice, or do you know, in my position, you're farther than me. What would you do if you're in my position to advance? And sometimes the conversations are super friendly and awesome. And sometimes they're just super cold, because you're cold calling someone asking for advice. It's not a normal call.
Yeah.
Either way, most people will hear that and go, okay, well, this is what I did. And then they'll give you a piece of advice. And so you learn a little bit of their story. Once you get some traction and some energy on it, it's okay, perfect. Time to end the phone meeting, because I'm not building a relationship over the phone. I'm going to build it in person. It's that is amazing. How often are you around your property? Because I'm in town next week. Can we snag coffee? I just want to learn a little bit about how you built your business, and it's good to know the players in our market. Most people will say yes to that. In my experience, way more than half the time, people will say yes to that. Their family didn't. Excuse me. Usually the people in real estate, they love real estate. Their family never really cared. Their friends don't care that they're in real estate, but they love the game. And when you're the person who's I want to talk real estate, most people are heck yeah, free coffee and talking about my business. People enjoy doing that. I never ask them. I don't tell them I'm open to buying stuff, because I don't know if they're going to sell me anything. It's not relevant. Most of the deals that we buy out of these meetings, they call 3 months later and they're hey, I have a friend who is selling a property. It's not what I'm looking for. I think this is a good deal for you. You should look into doing this. That's what it is more often than not. But it's never, ever, ever ask for a sale. If there's a sale and they know you and they're interested in your mission, whatever you communicated your goal was, they will reach out to you when there's an opportunity. I've never told someone I'm open to something. I've never proposed an offer on a property except for once. I've always let the deals come to me. And it's just by communicating your goals, learn their goals, and be the one guy who's not asking them to sell their stuff. And that's the number one way to buy things.
I mean, you have this massive smile on your face too, because I could tell that you enjoy this, man. Like you love this shit.
It's so fun, and it's so easy. Let me take it back. It's not easy. It's a ton of work. It's so simple. It's very, very simple, which makes it very repeatable. And it's fun because I talk to so many people about this, and everyone has some iteration of the same thing where there's a mindset. And I used to be a broker, so it took me a while to learn the mindset too. It's not about the sale. And my old boss would slap me because I used to work for the CoStar Group selling. You get the sale by not asking for the sale. And that was like the main thing when they train you how to do sales, is you have to ask for the sale. I never, ever, ever do that. And we buy more real estate than most people in our markets. There's 2 or 3 people who are bigger than me currently in Grant County, Washington. Technically, Cody is, because he has 12plex I don't have. But there's very few people who buy more real estate than we do, and no one who is buying in our market at the volume that we're buying. And we don't ask anyone to sell anything ever. I just get coffee meetings, so I have a lot of. I'm highly caffeinated through the day. But outside of that, like, I get coffee, I sit down and talk to people. And when someone has an idea on, hey, this is a deal that's stuck, or this is something that I wanted to work on, or you guys should take a look at this, you just get to spin the Rubik's Cube. And then it's just like a game. You're figuring out, okay, well, why hasn't it sold yet? What does the other party want? And how do we get a proposal in front of them that allows us to cash flow on long-term fixed rate debt? If I can do that, every deal we buy, I cash flow and it's long-term. My income just goes up for closing the deal. And that's all we do. Just figure out, okay, that's all I have to hit. Now let's figure out their goals and make sure we hit all their targets.
So you gave the first part of that conversation with the seller.
Yeah.
Or owners, we'll call them owners, right? Because that's the conversation with the owner. At some point, those conversations might evolve, or they might introduce you to someone that wants to sell their property. Given that all of your properties, or most of them, have been seller finance, talk me through how you introduce the subject. Like what's the dialogue there that you're using to kind of bring that up and get them to agree to do that?
That's perfect. Okay. So they've reached out to you now. You have a relationship. They reached out to you and they have a property that they want to talk about selling. Perfect. Just like you would any. So if you just jump into like, hey, would you be open to seller financing? You sound like someone who has no money and has no idea what they're doing. So you don't do that. That's what most people will do, is they're like, hey, are you open to seller financing? I'm only interested in seller finance deals. You don't know that you're only interested in seller finance deals. You don't know what the deal is yet. Just like you would any other deal on market or any conventional deal, you're going to ask your basic questions about, well, what's the actual opportunity? So tell me about the property. Tell me about the area. What's your experience been with this property? What don't you like about the property? I love knowing that. Like, okay, there's no such thing as a perfect property. So like, what's wrong with the property? What can be improved? Easy way to transition into seller financing or any financing is a simple question. How is the bank going to look at this property? It's one of my favorite questions because it asks almost everything, but really succinctly. How's the bank going to look at it? Asks, is there any major deferred maintenance? Do I need to put more money down because there's a problem? It's asking, how are collections and rent roll? Because if you're not bringing in enough money, the bank's not going to look at that favorably at that price. Or again, you're going to need to bring more down. But if you're asking questions on finance and status of the building, and you're opening up the conversation to, okay, I've learned about the property. Now I'm asking about how I'm buying it. Like if you're talking about the psychology of a sale, you've now flown from your general open-ended questions to a specific, like, okay, let's talk about the money. That's telling the other party I'm interested, and we're starting to talk about, like, we're talking about closing the deal. You're building a story of I am interested, willing, and able to close on the property. The way that you ask about seller financing is casually, as a simple question after they tell you how a bank's going to look at it. Awesome. How would you like us to take this out? Are you open to carrying a contract, or are we sticking with the bank? Or I actually think less wordy than that. Just call it to say, are you open to carrying a contract? And just pass it to them. A lot of times we just get a yes, and people don't ask that question. A question that we get all the time on our YouTube channels, by the way, Cody and Christian, multifamily strategy on YouTube. But a question that we get all the time is, how do you convince someone to give you seller financing? And the answer is you don't. You build confidence that you're the buyer. And if that's how you have to do it, you'll get there later in the conversation. But talk about the deal and then just ask them, are you open to carrying a contract? If you try to justify, because there's a bunch of reasons they would do it, but if you try to sell them on, well, there's all these potential tax benefits, you don't realize all the capital gains up front, you can receive interest on your payments, any of the reasons that people seller finance, if you give them the reason, you're almost definitely not going to get seller financing, because you don't know what their reasons are. You don't know their tax benefits. You don't know what they want to do with their heirs for their money. Just ask them if they're open to carrying a contract, and they'll give you a yes or no. And you get a yes a lot more often than people expect.
Yeah, it makes sense. So don't start with that. It's like,
no.
Okay, yeah, that's something that you kind of bring up casually after you've learned more about the property. That's a really great question, by the way. So for those of you listening, how's the bank going to look at this property? That's a golden question.
It's a transition to close sort of question. That is that belongs in every conversation. Tells you about the bankability, the maintenance, the money, and again, I mentioned this earlier, but the psychology of the sale. Like, you're the first one to bring up money, and you're talking about how are we going to put together the capital for this. That is a collaborative. It's the best question you can ask, I think, in anyone's general script to an owner or a broker. That is your first question as you transition to the close.
Beautiful. This is great, no, Christian, but there's someone sitting there at home right now and they're thinking like, okay, but how, right? Like, how are they doing this at scale now? Because maybe one or two, but there's so many. What are you finding? And by the way, the other thing too with this is that I'm not assuming, I know I've seen some of your videos on YouTube. You're getting some sellers to finance at better rates than you'd get from a bank. Like, I just saw you posted a video on YouTube about a month ago where you got seller financing for 5% or less than 5%.
Yeah, we have a lot. Even our Robinhood Village Resort, that's a $3.5 million loan at 4.25%. Yeah, we do a lot of lower interest.
And are these interest only loans, or are they amortized over 30 years, something like that?
It depends on the loans. Yeah, I prefer interest only, solely because on an amortized note, your actual principal is just going to pay down on that note. If you have a bunch of real estate, I like to choose where my principal gets paid down. I am all for paying down your debts. By the way, I'm a huge, our model is build it, stabilize it, optimize it, and then pay off all the debt. You have a debt-free mega portfolio. Like, that is the model. However, interest only is massively superior because you control the cash instead of giving it to the lender. You want to keep as much of the risk as possible on the lender, because if I pay down a loan and I lose that property, the money's all gone. Not that you lose a property, but I'm saying the risk of something going wrong, if you have more money invested in the property, you carry more risk. If you come in with less money in the deal, you carry less risk. So you want to keep it on the lender until you have enough money to pay your loans all the way off. So IO is how we do most of the deals. To your question though, before I go down a rabbit hole on interest only, majority are interest only. Longer terms. So you're looking for 5, 10, 15 years. 5 is a midterm. You need to have a plan to get that into new debt. We still do some 5 years, but you need to have a plan to get into long-term debt.
Sure.
But 10 years plus is considered long-term debt, and that is what we're targeting every single time.
What would motivate someone to take that deal under 5% interest? Because you can go to a bank right now and get that. So what's the motivation there? I'm trying to understand that too.
Yeah. So I think right now is actually a really easy time market-wise to explain this and to get those type of terms. So the reason being, a year and a half ago, properties are at an all-time high. Interest rates are at an all-time low. Well, now interest rates have absolutely gone crazy fast, spiking. So we went from 3 to 7.5%, like that. There are sellers who still want the price that they could have got a year and a half ago. However, the debt markets no longer support that. So you have to come in with cash to get the same return, which is unlikely. when the cost of capital goes up like that, pricing is affected. The fun thing with creative finance is you can modify whatever you want. You have price, you have terms, you have special clauses, you can negotiate your own balloon payment, whatever you can put in paper, you can do. And so on a lot of these deals right now, people have a specific price that they're after, but the debt markets do not allow that. So if you can come in and say, here's what I need to have this at 5%. And let's take a midterm product. Let's say we actually do want to bring it into a permanent financing in the future. 5-year debt product at 4%. It's going to cash flow for me there. One, it gives me time to get the income up so that I could get this into bank financing. So it lets me do my job as an operator. They can understand that. Two, it gives time for rates to adjust. If rates come back down, we can refi immediately and we'll get it done. But it's like one of the easiest ways to do it is a realistic way to give someone their price on a piece of property and pay interest. It's just saying, hey, the markets don't support this right now. Give me time to either improve the operations or for the market to correct. Either way, I can do this in a 5-year period. Even better though, a lot of people just understand I'm going to sell this where it cash flows. Like, I can maximize my price. I have this great note. I'm getting what I want. And it works for me as the seller at 5%. It's just not a problem. It has to work for all parties. But more often than not, you're doing these where you're giving them their price and they're giving you your terms. We've gotten price and terms before. Sometimes people just do deals that are fantastic. But more often than not, interest rate is the thing that we reduce because no one else can do that. If you're going through a bank, your interest rates are fixed. A best part of this strategy, by the way, so this is for those at home. I talked a lot about how we meet owners, how you connect with individuals and find deals without asking for the sale. The other thing you get to do with this is you can hop online anywhere in the country to like Crexy or LoopNet and look at deals that have been on market for 100 plus days. And instead of doing what most other people are doing, which is trying to send in a lowball offer and get it moved, you just call them and say, why hasn't this moved? Well, we haven't found anyone who's serious about buying it or whatever their reason is. And you go, okay, I don't have a problem with your price. If you're the first one who's called them, who's fine with their price, has been on market forever, and you're not trying to lowball them, that gets the conversation going. And that often is, okay, well, here's what it needs to look like. There's one other reason that you'll get low interest, and that is you have a property that is underperforming. So you have some maintenance things, CapEx, bad septic system, whatever it is. You have a property that's not doing well, and you're coming in and you're giving them a reasonable price, but you need to buy time, and that is the whole pitch. They know their property's underperforming. In the state the property's at right now, we need to inject a bunch of capital. In order to get you the price that you want, I need to have these payments to sustain the property and get through the project. And we will refinance out at whatever time that you negotiate. But that is another great way to get terms. People focus so hard on the price.
Right.
And you don't have to negotiate on that. If you can say, hey, I'm so confident in my project, I can give you the price that is going, like, I'll give you a reasonable price for when I'd buy it for fixed up. However, I'm going to be giving you that check in 5 years. Right now, you're going to lend me at 3% interest only because your collections are terrible. And we're going to do all the pain of renovating. We're going to put a new roof on the building. We're going to swap out some of the non-paying tenants. We're going to fix all the problems. And there's two reasons they would do this. One, they're going to make a lot of money without having to do the work. So that's awesome. Two, if I fail, what happens? They take back a property that's better than they left it because they've done a bad job managing it. And so that's where track record does help. Like, it gets easier as you get more properties, because now on these, someone comes in, they're like, well, what if you don't treat the property well? And it's like, well, here, look at the last 20 deals we did.
Right.
It's fun now that Google Maps has the thing where you can actually go through time. You can literally pull up the properties and go back year by year and watch the property get crappier and crappier as you go back through time. It's like, look at where it's at today. Look at where I bought it. Look at it where it's the year before. Like, this is what we do.
Mm-hmm.
Track record helps there, but no matter who you are, no matter how many deals you've done, that is a achievable task. Absolutely.
I really think that anyone who's trying to get into the game right now should take that little nugget right there that Christian just shared, and they should go do that. Go to Crexy, go to LoopNet, find something that's been on there for a long time, and give them their price because they haven't gotten it. That's why it's still on there. But then you give them your terms. And the interesting thing about that, and we don't have to spend all day here, but the observation is this: is that your focus is solely on how can we make this property fit our buy box, right? Like what are the terms that we can manipulate to have this still be a deal for us? It might not be a deal for everyone, but if you can do it. So one of the things that you shared, I don't know which podcast this was or which video. One of the things you guys said was like, hey, if we bought $10 million, or we bought $1 million property for $2 million, but we got it at 50 years, 2% interest only. Right.
Yeah.
I mean, that's a far-fetched example, but I was like,
yeah, bigger pocket. That was a good one. That was a Multifamily Mentors, I think was their series. Yeah. That was a great example.
Yeah. Yeah. It's like, well, of course you're going to do that deal because someone would, I mean, I'm not going to do the math here. It's going to take me forever, but like you actually do the math on it and it's traditional building. You'd be buying it at a discount because the payments are lower than that of a traditional, loan on the $1 million property. So I thought it was just a really interesting take. And something that probably not a lot of people are conditioned to think about. Hey, by the way, we're running up on time here, and selfishly, yeah. I had two more questions that I wanted to ask you.
Yeah, let's go.
So, and we spent a little bit of time here with the private money. You already explained to us how you built your network of owners, which is awesome. How did you build your network of private money / equity partners to come in and give the down?
Excellent question. Okay. So first of all, most of them are owners that I've met with because people have been playing the game longer than you typically also have money. So a lot of them are people with money who are like we just closed a 22 unit hotel that we're converting into multifamily. The owners of that, we have been trying to meet with, we've gone under contract for deals with them a few times, but they've always fallen apart. Over the last 3 years, we've been trying to figure out how we work together. They happen to own 14 hotels. I literally just closed on a property, so I had no money because I just spent what I had on acquisition. So the phone call to him was, I have a building, 22 units, that conservatively, when we have it leased multifamily, is going to be worth $2.3 million. We have it under contract for $1 million right now, seller financed. $300,000 down. I need someone to finance this for us. And we want to do this deal 50-50. And they're like, it's a great deal. We'll do the capital the way we structured it. They lent me 50% of the money. And Cody and I should say. But they lent us 50% of the money, and the other half of the money was their down payment. We then used the lent money to buy it. So we both put in the same capital contribution. I just owe him my half. When we refinance it, which he does on his projects, it usually takes him 3 to 5 months on these hotel conversions. He's going to refinance it, pull out all the money plus some, and he just gets first dibs on, we pay him back out of the refi. We'll all own the building, zero money in, and it's going to cash flow like a monster. That is a fantastic deal, but it's with another owner who I've met with, learning how they built what they built. And I met him at one of his hotels in my hometown, actually. It was like a 140 unit hotel. Met him in the lobby. His staff came over. It was later in the day, but they made us new coffee. So they came in. It was just fun. Like you sit down, he's like, oh, my staff will get us some coffee. You guys are good to go. Super excited to finally be doing something with you guys. And we had this long meeting going over everyone's goals, everyone's objectives. That's how we do it on almost everything. Everything else, you just run into people. If you're good at telling your story, like Cody and I do market a lot, but we show up at events and I just meet people and I talk to people. And my goal is just not to talk about myself. You guys do that for me in podcast, by the way. Thank you for this. I get talked about myself here, but it's the opposite. My job is your job. Interview other people, and you have it down by having a podcast. I need to do that at some point. But what you're doing right here is exactly what you do with other people. You ask them questions and learn about their business, and just sincerely learn from them. You're not trying to buy anything from them. You're not trying to get anything other than have an interesting conversation with an interesting person. And I do that with every, sometimes a lot of investors I met at a meetup. A lot of investors are people who I meet on, like I met an investor on an airplane ride to New York. And they sat next to me on the plane and we talked about their goals. They're like, oh, no way. You're partnered with that guy from Bigger Pockets. I'm like, yes, I also have an episode on Bigger Pockets you can also watch. Cody has the most watched episode ever. But like, you meet people all over the place. There's a lot of money out there, especially because our government is just dead set on printing it. There's no lack of capital. There's no lack of people with money. The piece is just showing a real interest in what is it that they're trying to achieve. I track it on an Excel sheet. When someone tells me, I have this specific goal and I'm trying to place this much money, I just keep that later. So when I find a deal, you do the deal debt, then the equity partner. When I need the right equity partner, I only have a few cells on that sheet. It has 4 columns, and this is all you need to know about people if you want to line up capital. You have a great conversation with someone. They say, hey, I'm trying to put money into real estate. I have like $100,000. I put, here's this person's name. We'll call him Mike. So this is Mike. Here's his contact information so I can reach him. Here's the amount of capital that he's trying to place, because I don't want to call someone for a deal where we're raising $1 million who has $50,000, right? That would be kind of weird. And then I just put down their goal. Like, what is it that they're trying to do? And so I have a little goals sheet. So I have, trying to reach $10,000 a month to retire family member. Wants to multiply money, wants to double their net worth in real estate in 5 years. Whatever it is they communicated, I just have a little note here. And that way I know when I find the deal and I line up a debt product, I know whose goal I'm going to help achieve, and I know who has the right amount of capital to do the deal. It's super simple, but I just keep it on a little, I just call it the money list. But it's a little capital list on Google Sheets where I can just dive in, and when there's a deal, I'm like, it's not just, oh, where's the money coming from? It's whose targets can I hit the best by aligning this deal to them? And you get a yes every time for capital. If you can pitch someone, it looks like this. Hey, I'd loved meeting with coffee with you last month. I finally found the right opportunity. This is the deal that I want to do with you. This is why. You mentioned that you wanted to do X and Y. And this particular deal is going to hit that because while the cash flow is a little bit low day one, we're getting a ridiculous price. Our terms are insane. And my management team is going to come in and we have a 1-year plan to get this thing to cash flowing. Like, it's going to knock out, let's say their goal is $10,000 a month. It's going to cash flow $2,000 a month. This is going to get you 1/5 of the way to your ultimate goal within a year of partnership. That is how this deal is going to work. Who's not going to say yes to that? Like, if you did good math and you can show them like quick, like that, here's the math I did, but you don't even really need to show them anything. You just explain to them like, this is the deal that I want to do with you. And you were my first call because it hits your goal. This is how it hits your goal. And that's it. I've had a no for capital like twice ever. Because you are pitching people what they asked you to do. You're literally pitching them what they told you.
Yeah, exactly.
You're like, I want to do this. Awesome. I have a way for you to do that. Like, you're going to say no to that.
That is so clutch, man. And honestly, you have given so many great pieces of dialogue. If you're listening to this podcast right now, you're watching this, I hope you're taking notes, because some of this dialogue it's foolproof. And I couldn't agree more. If you match, and you've said this multiple times now, like in different ways, but you said it multiple times. Find the need, fill the need. Right? So there's like, hey, what's your need? What do you like? What's your objective with the money that you have? and let me go find a deal that fits that, and then I'm going to call you. Right.
Yeah.
And that's awesome, man. Well, listen, we are over time, so I want to be respectful of that. In traditional gold mine fashion, though, leave us with one final gold nugget.
One final gold nugget. Okay. There are a ton of people, and this is my most common Instagram DM when people ask me questions. It's how do I get started, or have you done this strategy or this strategy or this strategy, like wholesaling, flipping, syndication. Figure out what you want to do and do that. You don't need to be a broker if you don't want to be a broker. If you want to be a broker, then get your broker license. People add steps. And so what I'm going to leave you with, which I wish someone told me 8 years earlier, because Cody's 8 years younger than me and figured this out. Figure out what it is that you want to do, and then just map out how it is that you want to do that. If you want to buy multifamily, don't start with single family. Go buy a 12-plex. Go buy a 38-unit building. Buy a duplex. Do the thing that you want to do without adding steps. This isn't a job. You don't need to build a resume. If you're going to be an entrepreneur, keep it super simple. Don't add steps.
Oh my God, dude. Yes. Stop waiting for permission. Just fucking do it.
Yes, absolutely.
Love it. Christian,